In this video, we're going to talk about Type D tax-free reorganizations. So Type D reorganizations can be acquisitive or they can be divisive. And in this video, we're going to be talking about the divisive type. So divisive tax D reorganizations are governed not only by Section 368, but also by some requirements in Section 355, which we're going to talk about. Now, there are three main types of divisive reorganizations. You've got spin-offs, split-offs, and split-ups. Now, I've got another video talking about the format for each of these because it can get a little complicated, so I refer you to watch that if you don't know what these are. In this video, I'm going to give an example of a spin-off, but the general rules apply to each of the three of these types. So let's say that we have a corporation called Treasure Hunting Incorporated, right? So this is going to be our distributing corporation. So I'll just abbreviate that DIST Corp, right? So this is our distributing corporation. They have a shareholder named Rachna. Let's say that Rachna owns all the shares of Treasure Hunting Incorporated. And Treasure Hunting Incorporated decides that they want to do a spin-off. So what they're going to do is they're going to transfer assets of Treasure Hunting Incorporated to a subsidiary, otherwise known as a controlled corporation. A controlled corporation. It's going to have to be controlled in order to get the tax-free treatment, which we're going to talk about in a moment. So this is our controlled corporation or subsidiary, our sub, right, of Treasure Hunting Incorporated. The Treasure Hunting Incorporated is going to give assets to sunken ship recovery, right? They go and they go into the ocean, try and recover lost treasure, right? So they give assets to this subsidiary, and then in exchange, what Treasure Hunting Incorporated is going to get is they're going to get stock. So SSR, sunken ship recovery, stock. So basically, they're giving assets for stock. Now, what Treasure Hunting Incorporated is going to do, once they get that stock of the subsidiary, they're going to turn around and they're going to give it to Rachna. So Rachna, who has started out as the shareholder of Treasure Hunting Incorporated, so she had stock in, we'll call that THI stock. Now she's also going to have SSR stock, right? So now if this were taxable, if it wasn't tax-free, this would be a dividend. Rachna would be taxed as a dividend. But we're assuming here that it's going to count as a tax-free reorganization, so she's not going to be taxed as a dividend. However, if she receives something that other than SSR stock, like let's say she gets cash also, then that'll be taxable. That'd be boot. So any boot could be taxable, right? And the same goes for when the sunken ship recovery. If they're giving something other than SSR stock to Treasure Hunting Incorporated, you could have taxable boot there too. But I'm just trying to give a simple example. One corporation gives assets, it spins off this sunken ship recovery, right, and says, all right, we're going to give them some assets, and we're going to get some stock, and then we're going to give that stock to our shareholder, Rachna. Now, for this to be tax-free, there's a number of rules. And one is that the distributing corporation, in this case, which is Treasure Hunting Incorporated, that corporation has to have control of sunken ship recovery immediately before the distribution. Another rule is that they have to, and by they, I mean Treasure Hunting Incorporated, has to distribute all of the stock or the securities of the controlled corporation that they're receiving. So remember, they gave assets in exchange for SSR stock. So they have to turn around and give all of this SSR stock to Rachna. Now, there is an exception. If they give up not all of the SSR stock, but enough that they basically gave away control, then it could also qualify as well. But generally speaking, they take the stock that they receive and they give it to their shareholder. Now, both of these corporations are going to need to engage in a trade or business afterwards. And you might think, hey, that's silly. Of course they're going to engage in a trade or business. Well, what does that even mean? Well, first of all, it means that a business that they were actively involved, that was engaged in during the prior 5-year period. So during the prior 5-year period, there was some business. What is this intended to do? This is basically saying, look, you can't just spin off some subsidiary and just give it cash or just give it stock and it not actually be a real business, right? There has to be some trade or business here for you to get tax-free treatment. If you're just trying to distribute cash over here and you can't just spin off a corporation and say, oh, here's our corporation. It's just got 50 million cash, but it doesn't do anything. That doesn't count. So it has to be in this case, sunken ship and treasure hunting, they have to be engaging in some kind of trade or business. And the purpose of the transaction can't be just simply to reduce earnings and profits. And if you don't know what EMP stands for, it's earnings and profits. I'll have another video where we talk about that, but just suffice it to say for right now that if this transaction is just structured to reduce EMP or something like that, or if it doesn't have any kind of a valid business purpose, then the IRS isn't going to respect this as a tax-free reorganization. So it has to, even though it's a divisive type of organization and it's kind of a little different than the other reorganizations we were talking about, it still has to meet the kind of core things for acquisitions and reorganizations, such as having a valid business purpose, continuity of interest, and so forth.